Hey everyone, and welcome back to another Bullish Bears video. I'm your host Kevin Dubrisky, and in today's video I'm going to be covering pullbacks. Now, a pullback in the market could mean one of many things, and it could be seen on any time frame. So in this video I'm going to be giving you guys different examples of pullbacks and how you might be able to use a pullback as your entry to catch the second leg of the move. Now, what are pullbacks? A pullback is a temporary reversal or pause in the direction of the current trend, often viewed as a natural part of price movement. Guys, a pullback is so healthy in the market. When we see a good trend, we don't want to be buying the highs or selling the lows. We want to wait for a good pullback to some type of area of interest, whether it's a fib, a key level, whatever it is, and we're going to cover a few of those examples shortly. The purpose of a pullback is to offer traders an opportunity to join a trend at a potentially better price. If we're moving from 100 to 150 to 200 to 250, we don't want to be buying it while it's pumping higher. We want to wait till that 250 pulls back to say 200. We could buy the dip, right? We know the expression of buying the dip. Key features: we typically do not break these key levels or areas of support and resistance when we are in a trend. An example would be supply or demand. Commonly retrace to significant areas such as support and resistance, moving averages, and Fibonacci levels. If you guys stick around, I will be covering these three examples right now. The first pullback entry model we're going to be looking at is a supply zone or order block. Now, of course, this would be a demand zone if we were going bullish, but this trade setup was bearish. So the first thing we see is that we did take out a level of liquidity to the upside, and we ended up failing back lower. So now that we had our push back lower from the highs, we would look to find our order block or supply zone. That's going to be this basing candle right here at these highs, where price gave us some type of initial reaction. We're going to use our rectangle tool and mark that out, and then we're going to be using that as our supply zone to find our next potential entry, which will happen sometimes in that day or in the next day. It does depend on market structure and what time frame we're looking at. So because this was a 15-minute time frame, what I would then do is I would look for a 5-minute candlestick entry. That's exactly what we got once we closed, rejecting the supply zone. Now, we could also use other tools for confirmation. An example, we could use order flow, volume analysis, whatever we are looking for. Another way we could have also taken this trade was because we were successfully rejecting this order block, we created a fair value gap on the 5-minute, which also held as a resistance. So we see we had our pullback to our supply zone or order block. We had our next leg, which created our new imbalance, which is our fair value gap, a pullback again, which gave us potentially a second entry or an area to add to our trade, and then it gave us a very nice move to the downside, which ended up sweeping some strong lows, and we would be able to mark those out by coming back to another time frame and seeing where we are pivoting. So I see a 30-minute demand zone. This would have possibly been my target to the downside on ES. So really great stuff, great trades, and that's how we would use an order block as our pullback entry. The next pullback we're going to be using is the exponential moving average. So to add that to our chart, we're either going to hit the backslash on our keyboard to bring up indicators, or we're just going to click indicators in the top middle. Then we're going to look up EMA, and we're going to click on moving average exponential. Now, you could click on this twice so that we could add one 9 moving average and one 21 moving average. So the first one we will edit, and we'll keep this one at 9, and we're going to make this green. The next one we're going to make as 21, and we're going to make that red. So we'll go 21, and we will do red, because this sort of gives us a bit of a view of almost like a MACD on our chart, so we know if we're green is above the red one, the 9 is above the 21, we are bullish looking for buyers. But if the red starts to push above the green, then we know that we're bearish looking for sellers. Now, on moving averages, we see that we're not getting these short entries at the highs. When we're taking shorts on something like the ES here, because we were just coming off of a bull trend, it took a little while, and we ended up finally switching lower around 1 o'clock. So that would be after the move already started. So moving average would really be once that move is confirmed. So once we start seeing a strong break of structure, which is when we start breaking some previous lows like this, that's when we could say, okay, let's see if a moving average is going to hold. We could then look at, say, the 5-minute time frame and see how are we reacting. We would look for pullbacks, so when price starts to hug the moving average. Now, obviously, guys, there's never going to be a time when the market gives us that exact entry consistently. It never will, especially with something like moving averages. So what we do is we look for the area around it. So at this point in the market, right here, we see that the area near the moving average is about 61.41. It's moving to 61.40. So we would know on this down move, we're not trying to take shorts around 61.35. We're waiting for the range, and the moving average is helping find us the range. So we could take the short somewhere up here and possibly put our stop loss above the 21, and we could look for a bit of a trend trade on that depending on how the market is moving, and you could always look to see it to target a key level or the next supply or demand zone depending on what your trading style is. The last tool we're going to cover today is the Fibonacci tool. This is a fantastic tool to use on most trends in the market, but we do have to be careful on identifying the right range and trend to put our Fibonacci tool on. Now, this trade right here, and the reason I keep coming back to the same setup with these different strategies, is so we could see how price reacts to each strategy on the same setup, so that if you're more of a fan of moving averages, you could see where your moving average entry would be. You could see where your order block entry would be, where your fib entry would be. This gives us different types of confirmations and sort of helps to adhere to whatever our trading style is. Now, what I would notice on this move right here is I see that we reversed at a high. So we failed to push higher. If we were able to see this type of continuation, these 3 bars right here, and we continued higher to about 61.68, then that would tell me that we have good momentum. We are going to continue, and we should put our fib to the upside. However, because we reversed after we broke those highs, I would then be looking to put my fib to the downside. So that way, we would look for our optimal trade entry within the 61 and 78%. Now, I'm going to use the replay mode to show you guys where and when we would be plotting our fib. Now, we wouldn't know when to plot our fib until we get our first few pullback candles. Now, as we see here with these 2 candles, we'll play one more. We now are starting to pull back. So at this point, we're able to plot our fib tool. And remember, guys, we're looking at the 15-minute time frame. Maybe we're plotting our fib on the 5-minute time frame, but we have the time. This is 30 minutes right here. We have the time to be patient and let it play out so we could properly place our fib. At this point, we have our 61% and 78%. This gives us our optimal trade entry, and depending on how you use the fib and how you could back test with it as well to get good results, I would usually look for an optimal trade entry to the downside, and then I would look for us to target the next negative 0.5 or the next supply or demand zone. So my trade setup on this would sort of look like that using the optimal trade entry, and that would be without using the supply zone that we formed as well. So we do have to remember we could add confirmations to it, and that's going to give us a way better entry and way better probabilities in our trade. We'll let it play out, and as you guys see, beautiful rejection off of that optimal trade entry before a very nice push lower, and that's how you could use the Fibonacci tool as a pullback entry. I hope this video helped you guys. Hit that like and subscribe button. Join me live here Mondays and Fridays on Bullish Bears YouTube. Take care, everybody. See you later.